Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets behind corporate filings, and today we're diving into Redwire Corporation's 10K report, where it looks like they've been busy juggling a lot from acquisitions to maybe a few bumpy landings. Redwire Corporation, a company making waves in the space and defense tech world, has just dropped its annual report for the year ending the 31st of December 2025. And let me tell you, this filing is packed, showing a company that is growing fast, but not without its growing pains. First off, the company is in a major growth phase. They've been snapping up other businesses, most notably Edge Autonomy earlier in 2025, which significantly boosted their revenue. Think of it like adding a whole new wing to a house after buying the neighboring property. This acquisition brought in over $100 million in revenue for the year, which sounds great. But it also came with a lot more costs. Speaking of revenue, Redwire saw a jump of about 10% for the year, bringing in close to $335 million. That sounds like good news, right? Well, the devil is in the details. While they made more sales, their costs shot up even faster by 23%. This is largely due to that Edge Autonomy acquisition and some pricey inventory adjustments that happened right after they bought the company. And when you look at their gross profit, the money left after directly paying for the items sold, it is a stark story. Gross profit dropped by a massive 61%, and their gross margin, which is how much profit they make on each dollar of sales, fell from 15% down to just 5%. This means for every dollar they sold, they only made 5 cents after covering production costs. That is a tough spot to be in, especially for a company in a high-growth industry like space and defense. Then there are the overhead costs, the selling, general, and administrative expenses. These expenses went from about $71 million in 2024 to a staggering $171 million in 2025. That is a jump of 140%. A huge chunk of this increase is due to share-based compensation, particularly something called Edge Incentive Units, which looks like a large bonus tied to their stock value. So while they're aiming for the stars, their corporate costs are reaching for the sky too. Adding to the financial strain, Redwire reported an impairment expense of over $34 million. This typically means they had to write down the value of some of their assets because they're not worth as much as they thought. Specifically, they took a hit on property, plant, and equipment intangible assets, and goodwill, their accounting term for the value of a business beyond its identifiable assets. It seems their Space Europe operations might not be performing as well as planned. All these factors combined led to a significant net loss for the year. Redwire reported a net loss of over $226 million, a big jump from the $114 million loss in the previous year. It is clear that while they are expanding their reach, profitability is still a distant target. Now let's talk about what is in the pipeline. Their book-to-bill ratio, which compares new contracts awarded to revenue recognized, was a healthy 1.32 for 2025. This means they are winning more work than they are currently billing for, which is a good sign for future revenue. This is partly boosted by that Edge Autonomy acquisition, adding a significant chunk to their awarded contracts. Looking at their backlog, the total value of contracts they have not yet performed on, it stands at over $411 million at the end of 2025. That is a healthy increase from the previous year, indicating continued demand for their services and products, especially in their defense tech segment, which saw a big boost from the Edge Autonomy deal. When it comes to cash, they ended 2025 with almost $95 million in cash and cash equivalents. This is a good increase from the previous year, helped by a significant amount of cash coming in from financing activities, mainly from issuing more stock and exercising warrants. This influx of cash was crucial as their operating activities used up a lot of money, over $177 million, largely due to changes in working capital. They are also investing heavily in their future. Capital expenditures, the money spent on equipment and facilities, were over $23 million for the year. A big chunk of this went into their defense tech operations, likely to ramp up production after the Edge Autonomy acquisition. Now, for a not so great detail, the company's auditor, KPMG LLP, issued an adverse opinion on their internal controls over financial reporting. This means they found some serious weaknesses in how Redwire manages its financial processes. They point to issues with implementing controls across all operations, especially in Europe and some US locations, and problems with its general controls. While thankfully this did not lead to any material misstatements in their financial reports for 2025, it is a clear signal that the company needs to tighten up its financial housekeeping, especially after bringing in new businesses. Despite these internal control issues, the company is pushing ahead. They've identified two key business segments, space and defense tech, and are focusing their strategies within them. They're talking about pioneering new technologies, expanding their spacecraft offerings, and delivering advanced autonomous systems. Looking at the big picture, Redwire is in a stage of aggressive aggressive growth, heavily relying on acquisitions and investments to expand its portfolio. While this strategy is driving revenue growth and building a strong backlog, it is not yet translating into profitability. The company is burning through a lot of cash, leading to significant net losses. The investment in Edge Autonomy is a major bet on the defense tech side, and it is still early days to see if it will pay off. The heavy reliance on acquisitions also means a lot of intangible assets like technology and customer relationships are being added to their books. This leads to significant amortization expenses, eating into profits. For instance, their intangible asset amortization expense jumped from just over $7 million in 2024 to nearly $25 million in 2025. A direct consequence of those acquisitions. A notable aspect of their capital structure is the Series A convertible preferred stock. This type of stock, which can be converted into common stock, carries significant liquidation preferences and dividend rights that are preferential to common stockholders. It is a complex financial instrument that can impact the value for common shareholders, especially if the company were to face financial difficulties or be acquired. The takeaway here is that Redwire is playing a high-stakes game in the space and defense industry. They are making bold moves through acquisitions and aiming for technological leadership. However, the current financials show a company that is burning cash and struggling with profitability. The internal control issues are a red flag that need immediate attention. Their success will depend on their ability to integrate new businesses smoothly, manage their soaring costs, and ultimately turn their impressive backlog and technology into sustained profits. It is a long road to profitability, and investors will be watching closely to see if they can navigate these challenges. Alright, that is our deep dive into Redwire's latest filing. What do you think about their aggressive growth strategy and the financial picture it paints? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deconstructions. And hey, if you want to chat more about these filings or get early access to our analysis, join our Discord community linked in the description. Thanks for watching, and see you next time on Corporate Decoder.